Imagine an AI scanning billions of data points in seconds, predicting market moves before human traders even sip their morning coffee. Now imagine it going head-to-head with Wall Street's sharpest minds. Welcome to the high-stakes showdown. Is AI better than humans at picking stocks? Today, we'll reveal where machines outshine human intuition, and where human instincts still leave AI in the dust. If you want to know which side could shape your investing future, hit subscribe right now. Origins of AI and stock picking. AI's journey into stock picking began in the 1970s with early quantitative models that relied on basic statistical methods to forecast trends. As computing power exploded, these models evolved into sophisticated systems capable of digesting massive amounts of data. Earnings reports, financial news, market sentiment, and even satellite imagery. Unlike humans, who depend on personal judgment and limited data analysis, AI treats the market as a pattern-rich landscape to decode. This shift marked a new era where decisions could be made faster and with more precision than ever before. Still, the question lingers. Can the experience and instincts of skilled human investors hold ground against tireless, ever-learning machines? Data processing speed, AI versus humans. Speed is where AI stands apart. Modern algorithms process millions of data points in milliseconds, pulling insights from news feeds, market indicators, and social media sentiment almost instantly. Humans, bound by biological and cognitive limits, simply can't match this pace. While an analyst might take hours to assess a report, AI can integrate it into trading strategies in real time. This lightning-fast processing allows algorithms to seize opportunities the moment they appear. However, speed alone isn't everything. Humans bring context, reasoning, and adaptability to scenarios where raw data might mislead. The ultimate advantage emerges when rapid AI analysis is guided by human judgment, blending quick execution with meaningful interpretation. Accuracy and performance records. Over the past decade, AI-driven funds have delivered impressive returns, often surpassing human-managed portfolios. Machine learning systems identify subtle market correlations, producing steady gains and improved risk-adjusted returns. But accuracy isn't guaranteed. In sudden market disruptions like the 2020 pandemic crash, many models faltered, unable to adapt instantly to unprecedented conditions. Humans, while slower, can recognize intangible signals such as geopolitical shifts or leadership changes, anticipating impacts beyond historical patterns. The data shows AI shines in stable environments, while humans excel during volatility. Increasingly, the most successful investment strategies merge both, allowing machines to handle large-scale analysis while humans intervene during moments that demand intuition and adaptive thinking. Emotional bias and human psychology. Markets often swing on emotion, fear, greed, overconfidence, and humans are prone to all three. These biases can lead to impulsive decisions, panic selling, or chasing unsustainable gains. AI operates without such emotions, executing trades purely on data and logic. Yet, machines aren't immune to bias. Flawed or incomplete training data can skew results. Humans, though emotional, can recognize their biases and adjust in real time, applying empathy and moral reasoning when needed. The real advantage comes from balance. AI ensures discipline, sticking to predefined strategies, while humans bring situational awareness and the ability to adapt strategies during extraordinary events. Together, they can reduce costly mistakes and make investing more resilient. Interpretability and transparency. One of AI's challenges in investing is its black box nature. Models often make decisions without clear explanations. For investors, understanding why a trade was made is crucial. Humans can articulate reasoning, weigh multiple perspectives, and communicate strategies in plain language. New techniques like interpretability tools aim to make AI decisions more transparent, revealing which factors influenced outcomes. However, complete clarity is still elusive, especially with deep learning systems. This is where human oversight matters. Validating AI-driven choices, questioning anomalies, and ensuring accountability. A future where AI and human reasoning work together could deliver both precision and trust, giving investors confidence in the decisions guiding their money. Adaptability in changing markets. Markets never stand still. AI models trained on historical data may stumble when confronted with unexpected changes, economic crises, disruptive technologies, or sudden regulation shifts. Humans, with their creativity and critical thinking, excel in such uncertainty, quickly reframing strategies. However, AI is catching up through continuous learning models that update themselves in real time. Some can detect early signs of change faster than humans, adjusting portfolios accordingly. Yet, when entirely new market conditions emerge, human adaptability still leads. Combining AI's ability to monitor vast streams of data with human foresight creates a dynamic approach, ensuring investment strategies evolve in step with ever-changing market realities. Cost efficiency and scalability. AI offers a level of scalability human traders simply can't match. Once built, AI systems can manage thousands of trades simultaneously, monitor global markets 24/7, and execute strategies with minimal operational costs. In contrast, human-managed operations require higher staffing, salaries, and infrastructure expenses. That said, developing and maintaining AI platforms demands significant upfront investment and technical expertise. Humans bring relationship building, negotiation skills, and nuanced company insights, qualities no algorithm can replicate entirely. The future likely belongs to hybrid systems. AI handling high-volume, cost-efficient tasks, while humans focus on strategic decisions that require trust, judgment, and long-term vision. This blend maximizes both efficiency and market insight. Ethical considerations and regulation. AI's growing role in investing brings complex ethical and regulatory challenges. High-frequency trading algorithms can exacerbate volatility, triggering sudden market drops. Without oversight, AI might exploit market inefficiencies in ways that harm fairness. While humans are bound by fiduciary duty and professional ethics, AI can be programmed to follow strict compliance rules, if these rules are built in. Regulators are working to keep pace, introducing frameworks for algorithmic accountability. Yet, human oversight remains essential to catch unintended consequences and enforce ethical standards. The safest path forward blends advanced AI capabilities with transparent, human-led governance to ensure innovation serves both investors and the stability of financial markets. Real-world case studies. Several high-profile firms demonstrate AI's potential. Bridgewater Associates uses AI to enhance its pure alpha strategy while keeping humans in decision-making roles. Renaissance Technologies' Medallion Fund, heavily automated, has delivered unmatched returns for years. Meanwhile, Goldman Sachs uses AI for data analysis, but relies on human traders for critical calls. During the 2020 pandemic crash, AI models initially stumbled, but human intervention minimized losses. Academic studies also confirm that AI can outperform humans, provided humans refine and interpret its outputs. These examples show that the strongest results come when AI's data power is paired with human adaptability, proving collaboration often beats competition in modern markets. The future. Synergy between AI and humans. The future of stock picking isn't a battle between humans and AI. It's a partnership. AI will grow faster, smarter, and more predictive with advances like quantum computing and richer data streams. Humans will remain indispensable for ethics, creative thinking, and interpreting unique market signals. The winning model is a continuous feedback loop. AI generates insights, humans validate and adapt them, and AI learns from that input. This creates an ever-improving cycle of speed and understanding. Investors who embrace this hybrid approach could gain an edge, making the question less about who's better and more about how to combine both for maximum market advantage. You've just explored the race between AI algorithms and human investors, discovering why the future belongs to collaboration, not rivalry, where we uncover the forces reshaping our financial world. Got thoughts or questions? Drop them in the comments. I read every single one. Share this with a friend who needs to see this. Subscribe now so you don't miss what's coming next. Trust me, it's worth it.